There's a warning sitting inside a Morgan Stanley research note right now that most people investing their own money have never heard. And by the time they do hear it, it'll probably be too late to do anything but watch it happen. This isn't some soft markets go up and down disclaimer buried in fine print. It's a specific call sent to the clients paying millions a year for that kind of access, saying the single trade that's been carrying this entire market for 2.5 years is running out of road and the money is already moving quietly before the headlines catch up. I've spent decades in and around markets. I've made fortunes and I've watched fortunes disappear. Sometimes mine, sometimes people I care about. And I can tell you the losses that actually hurt weren't the ones where I saw trouble coming and got it wrong anyway. They were the ones where I never even looked because I was too busy enjoying the ride to ask what happens when the ride stops. That's exactly where a lot of you are sitting right now and you don't know it yet. If your money's in tech, in an index fund, in whatever's made you feel sharp the last year and a half, stop half listening to this one. Being right for 2 straight years does not buy you the right to be right for the next 6 months, and the people managing the biggest pools of money on the planet just quietly told each other, the wind's turning. Before I break this down properly, I want one thing from you, and I won't pretend otherwise. What I'm about to walk you through took me years and some genuinely expensive mistakes to actually learn, and I'm giving it to you now for nothing. No course, no login, no funnel. All I'm asking is you hit subscribe before you get further into this video, because I put this kind of breakdown out regularly and most of it never lands in your feed unless you're already following the channel. That's not guilt. That's just how these platforms are built. Go ahead and do that. Then let's get into it properly. So here's the actual story, stripped of jargon. For roughly 2.5 years, one single trade has effectively driven this entire market, chips, AI, infrastructure, a small cluster of companies building the picks and shovels behind the artificial intelligence boom. That trade got so massive and moved so fast, it pulled the major indexes up along with it, even while a large slice of everything else sat still or quietly bled out underneath the surface. Nobody noticed because the headline number on your app kept climbing. Pull back the hood, though, and a lot of the supposedly safe household name stocks, the kind everyone's parents own, have actually underperformed for a long stretch. That's not opinion. That's simply what happens when a single trade sucks all the oxygen out of a room. Morgan Stanley's top strategist put exactly that in writing, sent it to institutional clients, and the takeaway is blunt. The engine that's been dragging this whole market higher is losing steam, and serious money isn't waiting around to find out whether it stalls completely. Here's a picture I keep coming back to because it explains this better than any chart ever could. Picture a basketball team with one guy dropping 50 points a night while the other 4 combine for barely 20. You can win plenty of games that way, but it's a fragile roster. The moment that one guy has an off night or twists an ankle, there's no depth, and you get blown out. Now picture the other 4 players finally starting to score 15, 18 points each. All of a sudden you've got a real team, one that isn't living or dying on a single guy's performance every single night. That shift from one superstar dragging everyone to a full roster contributing is basically what's supposedly starting to happen with money flow in this market right now. Chips have been the superstar. Now the ball is starting to get passed to the guys who've been quietly sitting on the bench, ignored for 2 years. And here's the uncomfortable part. If your whole portfolio is essentially a single bet on one player, when the ball finally gets passed around, that superstar doesn't necessarily keep scoring at the same clip. Sometimes he cools off hard right as everyone else heats up. That's not speculation. That's just what a rotation looks like in basketball and in markets. Let me tell you about a mistake of mine, because it'll land harder than any lecture would. Years back, I was riding a trade that felt exactly like this one feels today. Everyone I knew was in it. It kept climbing, regardless of what the news said. I told myself the story every winner tells themselves. At some point, this one's different. The fundamentals actually back it up this time. I'm not one of the suckers who bought the top. I had no exit plan because I genuinely didn't think I needed one. Why would you sell something that only ever goes up? Then it stopped going up. Slowly. At first, the kind of slow you can easily talk yourself out of worrying about. I told myself it was a healthy pullback, buy the dip, standard stuff. Then it wasn't a pullback anymore. It was a trend. And by the time I admitted that out loud, I'd already handed back more than half the gain. I didn't lose that money on the trade itself. I lost it on my own ego, on refusing to plan for the version of the future where I was wrong. That's the tuition that taught me what I'm handing you for free right now, no charge. So why are people prepared for something like this? Because of a pattern I've watched play out for 30 years among people who are otherwise plenty sharp. When something has worked for 2 straight years, your brain quietly rewires itself to assume it just keeps working forever. Nobody says that sentence out loud. Nobody actually believes they think that way consciously. But look at where the money actually sits. If you put anything into the market these past couple of years, there's a good chance a big slice of it is parked in the same small handful of names, either directly or buried inside an index fund that's more concentrated than you realize. That's not a knock on you. That's what worked. That's what every finance account online kept pushing. That's what your coworker was bragging about at lunch. But what worked the last 2 years and what works the next 6 months are 2 entirely different questions. And almost nobody actually asks the second one. They just assume the machine keeps printing. That assumption alone has wiped out more portfolios than any recession in history. I've watched this exact movie play out with real people more times than I can count. Someone rides a stock up huge, starts feeling untouchable, tells their spouse how smart they are, maybe starts mentally spending the gain on a kitchen or the mortgage, then the trade slows down. Nothing dramatic, no crash, just a slow bleed week after week instead of trimming some off the top while they still can. They freeze because selling feels like admitting the party's over and because nobody enjoys paying taxes on a winner. So they wait and wait some more. 6 months later, that gain is half of what it was. A year later, it's gone, and now they're sitting on a loser they originally bought as their big score. Nothing had to be wrong with the underlying company. What was wrong was there was never a plan for the moment, and the story changed. Hope isn't a strategy. Hope is exactly how 100% gain quietly turns into 20% and then turns red while you keep repeating to yourself it's coming back. Let's get specific now, because vague warnings are a waste of everyone's time and I don't do those. The corner of this trade Morgan Stanley is flagging as most exposed is the most crowded slice of it, especially the memory chip makers, the companies most tied to old school boom and bust supply and demand cycles. Their strategists actually drew a direct comparison to other commodity-style rallies that went almost straight up and then cracked hard once everyone who wanted in was already fully in. That doesn't mean artificial intelligence is a fad or the story's finished. It means the easy money in that specific slice has probably already been made, and the risk from here skews to the downside, not the upside. On top of that, some of the biggest buyers of AI computing power has started quietly admitting they built more than they currently need and are looking to rent out the excess. Sit with that for a second. When the single biggest buyer of anything starts trying to unload its extra supply, that's a signal the pace of buying is slowing, even if total spending is still enormous. In raw dollar terms, markets rarely trade on the absolute number, they trade on the rate of change. Slower growth, even off a giant base, is enough to spook a stock that was priced as though growth would never slow. Here's the part almost nobody's actually discussing, and honestly, it's the part that matters most for your money. This isn't a dump your chip stocks and hide under the bed story. That money leaving the trade has to land somewhere, and it's already starting to show up in specific corners. If you know where to look, first, inside tech itself, it's rotating away from the companies building the chips and toward the companies actually using them, the big platform businesses with real existing revenue in search, e-commerce, cloud, enterprise software. Those names already took their own painful correction earlier this year. A lot of that fear is already priced in. They've also got a lever that chip makers don't have as easily: the ability to cut costs fast if things soften, protecting profit margins even in a rough stretch. Second, money's rotating entirely outside of tech. into three areas worth knowing about: consumer companies selling actual physical goods. Because after a couple years of people spending on travel and concerts, that spending is swinging back towards stuff. Electronics, home upgrades, that kind of thing, transportation, railroads, shipping, freight, because that sector is about as close to a live pulse check on the real economy as you can get. And rising freight volumes usually mean the underlying economy is stronger than the headlines suggest. Third, and this is the one that catches people off guard every time, biotech. None of these three, consumer goods, transports, biotech, are exciting the way chip stocks are exciting. Nobody's making a slick video celebrating the railroad stock climbing 8% this month. That's kind of the whole point. The most crowded trade is always the one everyone's already talking about. And the trade about to work next is usually the one that sounds boring enough that most people scroll straight past it. I've made more money over the years off boring, ignored stuff than I ever made off the trade everybody was screaming about online. Because by the time everyone's screaming about it, the easy money's already gone to somebody else, and you're just there to hold the bag when the rotation hits. Biotech deserves its own explanation because the math behind it actually surprises most people. It's one of the most interest rate sensitive corners of the entire market. And here's the real reason. Not just a talking point. Historically, when interest rates are falling, biotech as a group has put up returns averaging close to 20% a year. That's not a promise. That's just the historical pattern. And there's a genuine mechanism behind it. These companies are what people in the business call long-duration assets. They pour money into drug trials today that might not turn a profit for 5, 10, sometimes 15 years out. When rates are high, the market barely values those distant profits because $1 a decade away feels close to worthless compared to $1 today. When rates fall, that math flips hard, and stocks that look like dead money for years can suddenly move fast. There's a second engine here too that rarely gets mentioned. A wave of major pharmaceutical companies are about to lose patent protection on some of their best-selling drugs, which means generics flood in and their revenue takes a real hit. The fastest way for those giants to refill the pipeline isn't building new drugs from scratch. It's acquiring smaller biotech companies that already have something promising in trials. That's real structural demand, not a guess dressed up as a prediction. Now, why is all this happening right now, specifically, rather than some vague point down the road? Because three separate things are lining up at once, and none of them are random coincidence. One, the chip trade got stretched so far that expectations hit the ceiling. And once expectations sit up there, even a genuinely great earnings report can read as a disappointment because great was already fully priced in, and unbelievable is what everyone was actually betting on. That's a rough setup for anyone still piling into that trade at these prices. Two, oil has been sliding, and people constantly underestimate how much of the economy runs downstream of energy costs. Cheaper oil means cheaper shipping, cheaper manufacturing, cheaper everything. And that filters into inflation numbers with a bit of a lag. Once inflation cools, the Fed gets more room to ease. And once the Fed has that room, money sitting defensively starts hunting for a home in the beaten down corners of the market. Three, the Fed itself has been talking noticeably softer recently, especially after some weak jobs. Numbers reminded everyone the Fed doesn't only fight inflation, it's also on the hook for employment. Stack all three dominoes together: a stretched trade, falling oil, a softer Fed, and you get exactly what's unfolding. Money leaving the most crowded corner of the market and flowing into the stuff everybody had already written off. I'll be straight with you. None of these three things on its own would be worth much of your attention. Stretched expectations happen constantly, and trades can stay stretched a lot longer than seems rational. Oil dips and recovers all the time. The Fed talks soft, then talks tough again 2 months later. It's the fact that all three are lining up in the same direction at the same time, and that makes this worth paying attention to instead of filing away as background noise. That's how you tell a real signal apart from just another headline trying to get a click. One domino falling means nothing. 3 falling in a row, all pointing the same way, that's when I actually start moving money. So here's a real mistake I want to save you from, because it isn't the mistake most people assume it is. The mistake isn't owning tech. The mistake isn't owning chip stocks. The mistake is having absolutely no plan for what you do the moment the thing that's been carrying you stops carrying you. Every serious trading desk, every hedge fund, every real institution decides its exit before it ever puts a dollar to work. They know in advance, if this trade moves against me by a set amount, I'm out. No debate. If it moves in my favor by a set amount, I take some profit off the table. Also, no debate. There's no hoping, no praying, no it'll bounce back eventually. It's mechanical, almost boring. And it's exactly why professionals tend to survive rotations that wipe amateurs out. Most everyday investors were never taught that system. They were taught buy, hold, and cross your fingers. And that works beautifully right up until the market rotates on them, at which point it becomes the single most expensive lesson of their financial life. And I already know the pushback some of you are typing right now. It's not timing the market. It's time in the market. Sure, fine. Over 30 years, that's a decent bumper sticker. But that advice was never meant to tell you to stay maximally concentrated in one crowded trade forever while treating rebalancing like some kind of sin. Time in the market and having zero risk management are two completely different ideas, and people confuse them constantly because it's simply more comfortable than admitting they never actually built a plan. So what do you actually do with all this? Here's the simple version. No fluff attached. Watch 3 things. Signal 1. Are chip stocks losing strength relative to the rest of the market? If they keep underperforming while other sectors hold steady or climb, that confirms the money is genuinely leaving. Signal 2. Is oil staying flat or falling? Because falling oil is basically fuel for this entire rotation, easing inflation and giving the Fed more room to move. Signal 3. Are earnings estimates getting revised upward outside of tech in places like consumer names, transports, financials, biotech? If those upgrades are spreading beyond the usual handful of names, that's confirmation. This is real and broad, not noise. None of this means selling everything you own tomorrow morning in a panic. It means you stop assuming the last 2 years just repeat automatically, and you actually start asking where the money's heading next instead of celebrating where it already made you rich. Zoom out with me for a second, because I don't want you walking away thinking this is some short-term trading gimmick you forget about next week. What's really being described here is the market shifting into a fresh phase of the economic cycle, the rough patch, the layoffs, the belt tightening. A lot of industries already went through that. Companies got leaner, costs got cut hard. Now, as revenue starts flowing back into those leaner, tighter operations, profits can grow faster than people expect, simply because the cost side is already under control. That's exactly the kind of environment where beaten down sectors everyone ignored start delivering upside surprises. While the crowded, expensive trade that already ran hard has a lot less room left to impress anyone, this isn't luck. This is roughly how markets have behaved at this stage of the cycle for decades. The people who understand that pattern position ahead of it, the people who don't find out about it after their account already took the hit, and by then it's too late to do anything but nurse the loss. So here's my challenge to you, and I actually mean it. Tonight, not tomorrow, not this weekend when I get around to it. Tonight, pull up your brokerage account, your 401 kilobits, whatever you've got, and be brutally honest about how concentrated your money really is. Count how many of your different positions are really the same bet, wearing a different ticker symbol. If that number makes you a little uncomfortable, good. That discomfort means you're finally paying attention instead of coasting on the last 2 years. You don't need to blow anything up or panic sell. You need an actual plan for when to trim, when to rotate, and when to just sit tight, decided before the market forces that decision on you, because it will make that decision for you eventually, one way or another, and it is never gentle about it. That's the entire difference between people who compound real wealth over a lifetime and people who ride one great run all the way up and then watch it slip through their fingers, calling it bad luck afterward. I'm not telling you any of this to scare you. I'm telling you because I'd genuinely rather you hear it from me now for free than learn it the expensive way 6 months from now. One last thing before I let you go. None of what I just walked you through is complicated. It's not some secret formula reserved for people with a Bloomberg terminal and a corner office. It's 3 signals, an honest concentration check, and the willingness to actually build a plan instead of just holding onto a prayer. The reason this kind of thinking gets buried in research notes that only reach institutional clients isn't because it's too advanced for regular people to grasp. It's simply that there's no incentive for anybody to hand it to you for free. I don't have that problem. I've already made my money, I've already made my mistakes, and at this point I'd genuinely rather help you sidestep the ones I made than watch another comment section full of people asking what happened 6 months from now when it was all laid out plainly right here today. So don't just watch this, nod along, and go back to whatever you were scrolling before. Actually do the thing. Check the account, run the real numbers, decide your plan before you need it, not after. And that's the whole game. And honestly, it always has been.